Ladies and gentlemen, good day and welcome to Solarium Green Energy Limited H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Krishna Patel from Investor Relations Team E&Y. Thank you, and over to you, ma'am.
Thank you, Vikra. Welcome to Solarium Green Energy Limited H1 FY26 earnings conference call. To take us through the results and to answer your questions, we have with us the top management of Solarium, represented by Mr. Ankit Garg, Chairman and Managing Director, Mr. Pankaj Gothi, the Whole-Time Director, Mr. Himanshu Garg, Chief Financial Officer, and Mr. Rohit Jindal, Vice President, Finance and Accounts. The discussion that we may have today may contain certain forward-looking statements relating to future events and performance. Numerous factors that could cause actual results to differ materially from those in the forward-looking statements. New factors emerge from time to time, and it's not possible for the management to predict all the factors, as is the extent to which any combination of factors may impact Solarium's business or cause results to differ materially from those contained in any forward-looking statement. With this, I may now hand over the floor to Mr. Ankit Garg for his initial remarks.
Thank you, Krishna, for the introduction. Good morning, everyone. Today, I will be sharing few insights from our H1 FY26 earnings call. We concluded our board meeting on 14th November. I will start with a brief overview of half year, which will give you a broad highlight of the business. Post that, we will open up for a Q&A session. The first half of FY26 has been a period of strong growth for the solar sector, supported by robust government initiatives, rising residential adoption, and accelerating policy interventions like PM Surya Ghar Yojana, GST 2.0 implementation, and continued momentum in the renewable infrastructure. These tailwinds have translated into a healthy demand environment for the distributed solar solutions, an area where Solarium has built a strong foundation over the last 5 years. Moving to the financial performance of H1 FY26, Solarium delivered robust results with a 43% year-on-year increase in revenue, a 65% rise in gross margins, and 36% improvement in EBITDA, while profit after tax expanded by 22%. Although the revenue growth remained strong, it was moderated by prolonged and excessive monsoon conditions across India, as well as demand-supply postponement caused due to rollout of GST 2.0 in September 25. Despite this temporary slowdown, the reduction in GST rate on modules and inverters from 12.5 to 5%, effectively reducing the composite GST rates by 5% approximate, is anticipated to accelerate solar adoption and enhance market adaptability in subsequent quarters. The company continues to observe healthy demand and increased traction for solar installations nationwide. Regarding our workforce, we have experienced an increase in employee count driven by our foray into manufacturing. We have proactively invested in our people to strengthen our sales and execution team. Finance cost remains elevated due to increased working capital requirements, primarily driven by delayed government receivables, particularly in defense-linked projects. This has impacted short-term liquidity and contributed to higher interest expense. In terms of business segments, residential and government projects remain our core contributors and are primary revenue-driven drivers for Solarium, contributing 32% and 36%, respectively, of H1 FY26 revenue. During this period, The residential footprint expanded to additional 25 cities, facilitated by franchisee growth through the Solarium Class A initiative, wherein we onboarded approximately 450 new channel partners during significantly strengthening our reach and customer access. Government orders also remain robust, backed by a strong execution track record across multiple states. Order visibility continues to be a key strength for Solarium. As for H1, we have unexecuted order book of 229 crores, 209 crores in L1 orders, and a bidding pipeline of over 900 plus crores. Together, this provides clear visibility for growth over next several quarters. Operationally, H1 FY26 was a milestone for us. Supporting our backward integration efforts, we commissioned our 1200 MTPA structure manufacturing facility in July 25, which is expected to generate an estimated 5% cost advantage. Our focus now shifts to the next major milestone, the commissioning of our 1000 megawatt automated solar module manufacturing plant in Ahmedabad. This is a strategic step that will position Solarium as a vertically integrated player and strengthen our long-term competitiveness. We are also aggressively investing in digital initiatives, including a B2C application for residential segment, which is designed to enhance user experience by providing real-time order tracking, payment updates, and related functionalities. This is an important step towards creating a superior and seamless customer experience. Looking ahead, our priorities for H2 FY26 remains clear. Successful commissioning of our module manufacturing plant, strengthening our residential franchisee network, scaling execution in government and turnkey segments, and driving cost-effective efficiencies through integration and operational discipline. With strong industry tailwinds, a healthy pipeline, and a clear strategic roadmap, we remain confident about sustaining our growth trajectory and delivering long-term values to all our stakeholders. We can now move to QA session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maitrisha from Sapphire Capital. Please go ahead.
Yeah, hello, good morning. Am I audible? Hello?
Yes, you are audible. Please go ahead.
Yeah, firstly on the solar manufacturing, that we're starting the module manufacturing, when do we expect this to commission? Q4 or Q1 of FY27? Hello? Hello, am I audible?
Hello?
Yeah, can you hear me?
Yes. So we are expecting to get it commissioned by mid-January.
Mm-hmm. And are we also planning to get into cell manufacturing maybe in FY27, or we sticking with the module manufacturing for now?
It is actually a very forward-looking statement for us to update on this right now. But on a short-term basis, we are planning to first get our plant commissioned by January, and then we'll update on the cell manufacturing.
Okay, and when do we expect this to reach the 85% utilization?
So, ma'am, we have our own self-consumption orders lined up already, and in the recent REI we have already received some orders for supply of 80 megawatts of panel supply orders in REI already. So the main target is to reach the maximum capacity at earliest.
Okay. And once we have this plant commissioned and we also have the solar structure manufacturing, what sort of cost benefit do we expect, and how do we expect our margins to play out in the second, especially in the fourth quarter of FY26 and for the entirety of FY27?
So with structure manufacturing, we are estimating a cost advantage of around 5%. With module manufacturing in place, certainly the cost advantage and the supply advantage will be there. But still, we have not estimated the cost advantage till now. But the supply advantage will be very big for us. Yes, Himanshu. Himanshu, can you take over?
Yeah. Am I audible? Hello.
Yes.
Yeah.
Yeah, so I think I'll just start from the beginning. Thanks for the question. So on the first part, as I was mentioning, not too sure if Ankit has answered it or not, but I'll just maybe in the interest of saying everyone, I'll just repeat also. So we expect the module manufacturing to go live by mid-January somewhere. I'm expecting the shipment to go out from China later this week and expected to get received in India by mid-December, and another 15 to 20 days for its trial runs, and by the mid-January to end of January, we expect it to be fully operational. That's on the first part. On the second part of your question, I think that's around the margins, if I've heard it right.
Yes.
So
yes.
There are two parts to this question. I'll rather try to answer it in two parts. One, obviously, with the step which has already been done around the module mounting structure, though it's a lower cost portion for the overall solar plant, which contributes say about 10%, right? In the overall plant, solar plant, we are seeing a cost benefit of about 4 to 5%, which actually entails margin benefit at an overall only on the EPC segment part to about 0.3 to 0.5% effectively. On the second part, for our module manufacturing portion, though, so there are two ways to look at it, right? So first, how the plant will operate on its own, though it will be a captive unit going forward, right? But how the plant will be operational on its own as a standalone unit. So as a standalone unit, plant will be able to generate anywhere about 1,000 crores plus revenue if we'll be able to operate it at 85%. I think you have a question around how do we expect the capacity utilization. I think in the initial period for about first couple of months, we expect the utilization should be anywhere about 40 to 50% for first couple of months, and slowly, gradually, over the next couple of quarters, it should reach anywhere between 75 to 80%, and the target for that is before Q2 end. So internally, we are targeting to utilize 75% within first quarter FY27. On the margin side for that plant itself, I think on the EBITDA level, if we see that plant standalone, that should be able to operate at 12 to 13% margin. Now, how will that translate to our EPC segment? Fundamentally, EPC, as we don't want to probably waste or so not utilize the plant fully. So there'll be a mixture of some bit of external sales and some bit of captive consumption. And as we grow our segments, as the acceptance of the module goes up, I think that is the time when the full margin will be able to capture within that. Otherwise, it's a standalone. We want to see it as a standalone unit, which will be captively used. so as to make it more sensible.
Okay. Thank you for that detailed answer. Secondly, this module manufacturing that we are setting up, will it be capable of using the DCR cells that will probably be a compulsion from June 26 going forward?
Yeah. So the unit we are installing is with the latest technology, which is the TopCon technology, and which can also be upgraded to the next generation technology, which is expected to go live in next 3 to 4 years, which is LJT. And in terms of utilization of DCR and non-DCR cells, it is capable of using both the cells.
Both the cells. Okay. Just last question on the guidance, if you could talk about the seasonality, because the first half, because of the rains and also there was a delay due to the GST regulation changes. What do you expect from the second half, like growth-wise, and also in FY27, what sort of growth are you expecting over FY26? And even if you can give some color on the margins, EBITDA margins going forward.
So I think again we continue to refrain from any sort of guidance, given we are still very, very young in terms of as an organization we are young, right? So we've not seen much on that side, but in all transparency, we are still targeting the growth which we have experienced in past couple of years, more specifically around EPC. So if we go deeper into the numbers, say for FY23 to FY25, our EPC segment has grown by 4x over 2 years, right? We have doubled up it every year. So we continue to see that traction, not only from, say, what we are targeting, but also the numbers can be visible from our order pipeline, which is, say, in terms of what is the unexecuted order book, which itself is about 230 odd crores, another 210 odd crores pending for LOA, means we are already L1 in those orders. So we don't see any challenge in terms of not hitting those numbers in terms of growth percentage which we have experienced in the past. That's a straight answer to that. On the second part, how FY27 looks like, FY27 will be in addition to this. We also kind of foresee once our module manufacturing plant goes fully operational. When I say fully operational, that means capacity utilization upward of about 75-80%. So there will be additional revenue which will also start flowing in from the module sales, which obviously over and above which is not going to get consumed given in first couple of quarters or so. We want to achieve our operational efficiency as quickly as possible.
I have a few more questions, but I'll join back in the queue.
Sure,
Thank you so much.
Thank you. Before we take the next question, a reminder to all, you may press star and 1 to ask a question. The next question is from the line of Anj Singh from AG Investments. Please go ahead.
Hi. Thanks for the opportunity. So, sir, just wanted to understand your H1 revenue grew 43% YOY and EBITDA approximately 37% as per your given investor presentation. So, what were the key drivers of this margin expansion and how sustainable are they going forward?
So, thank you for the question, Anj. So, on the margin expansion side, we have actually initiated one very, very recent initiative, which is Solarium, wherein we have started onboarding franchisee partners who are getting the orders for us. So that is one of the wherein we have seen a great traction, not only in terms of numbers, but also in terms of margins, which also entails a higher expense side for us. But as we scale this up, this initiative gets scaled up, we foresee that the commission outgo will stabilize, but and the margins will be able to sustain.
Understood, sir. So my second question is on the plant that you are planning to set up of 1,000 megawatt solar module manufacturing. So just wanted to get some, current status of this project, example, land, machinery, and what are the approvals that are still pending?
Sure. So I think I tried and answered that in the last question we asked, but I'll just repeat that. So uh, the the machines are expected to get shipped from China later this week. And expected to reach India port by mid-December or say third week of December. The overall installation time is about a couple of weeks from there, and then about 2 to 3 weeks for the trial runs. That's how at the latest fully operational plant will be end of January. The target is somewhere between mid-January to end of January. That's how we see in terms of the current status of the plant.
Understood, sir. Understood. That's helpful, sir. So one more question, if I squeeze in. So, your working capital appears to be stretched. Example, trade receivables up significantly. So, how are you managing receivables and payables and inventory as you scale the business?
So I think we tried because we expected this question, and thanks for asking this for everyone clarity also. We tried and answered this within the presentation itself. So we obviously, and Ankit also tried and capture this during his speech. So we experienced some sort of delays, more specifically in the trade receivables from the government-linked projects, right? And within the government-linked project also, it was a delay from a defense-linked project specifically. I can put it very, very transparently that because most of our trade receivables were from defense-linked projects from BSF and MES, which is Border Security Force and Military Engineering Services. And both the agencies were stuck from somewhere about May to almost like August because of Operation Sindoor. We experienced the India-Pakistan war there. So almost most of the people were not reachable during that time. So it is more specific one-off reason, I would say, which has been there. If we further break it up again with a very, very transparent structure, there were no delays from the other government projects or say residential. So residential business, we have reduced our working capital cycle. But specifically this, as we have experienced some sort of delays. Or say the other projects from NTPC or other players, we have not experienced any such sort. So it is more of one-off kind of thing which has happened because of something beyond anyone's control.
Understood, sir. Understood.
So almost like 5 months, there was no one. And we now started receiving those money back from between August and September itself. We have received almost about 20-25 crores and between October. So we expect to clear that off by December itself.
Okay. So one more question, if I may. So one on that, basically employee cost rose approximately 80% year on year, according to the presentation. So how do you expect employee cost growth to behave in H2 FY26 and FY27 as you scale?
So thank you again. I think we expected this call. Thank you for asking this. We tried to capture that as well in our presentation. So if we further break this up, the employee cost, you are absolutely right. The employee cost has gone up almost like 80% year on year between H1 to H1. But if we see this number from a different lens, that the employee cost being a constant from H2 to H1. So there has not been any sort of increase which has happened from last year H2 to this H1, which is half to half. So we are not seeing any further increase there. Rather, more specifically around the main part of the business. But as we add up our manufacturing facility, which I tried to capture it in the last question also being asked, right? That it will be a standalone unit, right? Which will generate its own sort of contribution to the business. But if we see the business which is going on, we don't foresee any sort of increments, rather some sort of efficiency will start coming into the employee cost.
Understood, sir. That's helpful. Thank you, sir. That's from my side. All the very best.
Thank you very much.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and one. The next question is from the line of Vinay Lakhera from Ratnatraya Capital. Please go ahead.
Hello.
Go ahead.
Yes.
Hello.
Okay.
Yeah.
Go ahead.
Hi, sir. Hi, sir. I just had a quick question on the payment cycle. So, for example, you mentioned about the government projects. So there was a delay in the receivable part. So on the residential and the commercial side, how does the payment happen? Like, what is the cycle for that?
From the payment as in to our vendors or receivables from the customers?
From the customer, actually.
So in terms of residential, there is hardly any sort of credit which we offer to the customer. So if we see practically in actual numbers also, the overall AR will not be even less than 10 days. It's anywhere between 7 to 10 days. More specifically in terms of payment terms to your question, so we receive the money from the customer in tranches, and how those tranches are being bifurcated is first amount we receive from the customer as a token amount, anywhere between 10 to 20,000. Say, as an example, we have closed a customer that say 1.5 lakhs for maybe 3.2 kilowatt customer. So we kind of receive anywhere between 10 to 20,000 as advance. Then before dispatch, he has to pay almost 100%. There are certain points when we offer the customer the credit, which are majorly towards the finance cases when we are bound to receive the money from, say, various customers, from various financial institutions. When effectively there is no credit risk, but the money is due from the financial institutions. Or some places we receive, say, multiple bulk files, bulk number of customers from a specific location, and that gets guaranteed by a specific RW or someone else, and we offer them credit only for the portion of the money which is to be received from the government.
Okay, got it. So, like, according to my understanding, this subsidy disbursement happens at the end, right? When everything is complete.
Yeah. Correct. So until we don't approve the file at the portal of government, the subsidy will not be received by the customer. So that is where we get covered ourselves as well. So unless we don't approve the file, the subsidy can't be received by the customer.
Okay, got it. So one more question, like in terms of involvement of Solarium. So for example, when the customer needs the solar panel installed, from which point the involvement of Solarium happens, like with the customer, like when are you in contact with the customer? Is it from the start itself or?
From the start itself. So we are offering an end-to-end solution to the customer, wherein it's, say, you intend to get solar system installed, right? So from the first step itself to finally getting the subsidy dispersed, we are helping you end-to-end. From getting the system installed, doing the drawing, doing all the sort of engineering, then getting the financial thing also sorted. We have tie-ups with various financial institutions, as well as, say, the scheme being offered by the government of India in the name of wherein the PSU bank has been mandated to offer the loan at very, very subsidized rate of less than 7% to the customers, right? So there also we ensure that you don't have to visit the bank. Our employee will go on your behalf, and you only visit once when the final signing has to happen. So we kind of handle the complete consumer journey for the customer.
Okay, got it. So one last question on the competitive intensity side. So like, as you mentioned, it is a customer facing kind of thing, like you have to reach out to the customer and come in contact with them. So is it geography specific, the kind of competition you face? Because like maybe in one particular geography, one player has a good stronghold or like a strong foothold over there. So something like that. Is my understanding correct in terms of competitive intensity?
Yeah. So your understanding is absolutely correct, Vinay. To add on to that, more specifically, how the things happens around the competition. So we have to also kind of decipher it into different perspectives, that our major competition is the local installers, right? When I say local installers, there are people who are like electricians. So nowadays, lot of local people are coming up and becoming installers, which are not being able to kind of serve the customer like what we offer on the table, right? In terms of execution timelines or turning the things at a faster pace. So that is also a very, very strong competitive edge, given still, like today, more than 96-97% of the business is unorganized.
Okay. Sorry, like one last question if there is time. Can I ask?
Go ahead, please. Go ahead, please.
So in terms of competition only, like we saw a lot of solar players and a lot of other players, maybe in the pump industry, etc., are also getting into rooftop due to the market size and the growth over here. So in terms of competition, do you feel that the size of the player and the kind of capacity they have, that will matter, or in the kind of execution in terms of customer-facing department, will that matter more? So, like, because, for example, if a big player enters, then the landscape will be a completely different for the smaller ones.
Sorry, but I think you answered it in your question itself. Given most of the bigger players don't want to get into this very, very execution heavy business. So there are two parts to it. A lot of people get confused in terms of, okay, Adani is doing the rooftop and Waaree is doing rooftop, but in actual, nobody is doing the rooftop, including Tata. So they are only supplying the products. Nobody is there in terms of executing. There are very, very few organized players who are there doing the execution part. So if I talk about, say, Tata, right? Tata is only supplying the kits. They are not there doing the execution. Or say Waaree. So everyone has their own sort of specific goals of doing a specific part of the business. So in case of Waaree, it is to sell modules. In case of Adani, it is to sell modules. In case of Tata, it is to sell the kits. But for us, the main part of the business is to execute. We are going ahead with our manufacturing facility, going backward integration, not to avoid any sort of forward reach which we have already created.
Okay, got it. Thanks a lot for answering the question. I'll wait in the queue. Thanks a lot.
Thank you. Thanks, Surya.
Thank you. Ladies and gentlemen, a reminder to all, anyone who wishes to ask a question may press star and 1. The next question is from the line of Shruti Malpani from Earth AIF. Please go ahead.
Hello, am I audible?
Yeah, Shruti, hi. Go ahead, please.
Hello, sir. Congratulations on the great results. I have a few questions. So, for the module manufacturing facility that we are setting up, so is it like more like a assembling, and where would we be sourcing the cells from? Is it from China or domestic suppliers? Sorry,
Shruti, you just break up. I don't know if it is for me or for everyone, but if you just can repeat for last 10-15 seconds.
Yes. Is it better now?
Yeah, better. Thank you.
Yeah. So for the module manufacturing facility that we are setting up, so where would we be sourcing the cells from? Would it be from the Chinese manufacturers or domestically? How would that work out? And this would be an assembly only, right? For modules.
Yeah, so it's I don't know how to put it. So I'll answer your second question first. I don't know how to put it, what do you mean by assembly, but this is what the module manufacturing process is. Whether you want to call it assembly or integration or whatever, but the machines which we are importing is the latest machines available worldwide, which is one of the most reputed suppliers, which is Jinsheng, right? So which is amongst top 3 machine manufacturers for modules. So it is fully automated. You can call it as assembly, given the manufacturing process of module as such, which can be called as assembly. But yeah, this is what the only process available is. On the first part of your question, initially our plan is to obviously manufacture non-DCR as we all know that over next couple of years, non-DCR will go away, and by that time, the DCR capacity will also be sufficiently being placed in India. So then we start sourcing the DCR sets as well. But given at least what we foresee, the kind of order books at an India level we have, right, for non-DCR, given the DCR mandate is only for the projects, so or the vice versa, we are allowed in India to use non-DCR cells for all the projects which are being bidded before 31st of August. And if we realistically see, there is enough pipeline which in terms of execution timelines will be able to complete over next 1.5 to 2 years. So we don't foresee non-DCR going away over next 1.5 to 2 years.
Okay, so any orders that were bidded after 31st, you'll have to use DCR components completely? Like,
after
is that correct?
31st of August. Correct.
This 2026.
But
So to 2025, I'm sorry.
Yeah, this year. So so effectively that 30th June timeline, which was earlier there, that nobody will be able to use anything after 30th of June, goes away. Now, as per the latest guidelines, the 30th June can also be deferred. How it will get deferred? That all the projects which has already been bidded for. So I'll put it this way: we have an order pipeline wherein we have bidded for more than 900 crores worth of orders. Now those all are eligible for using non-DCR because most of them were being bidded before 31st of August.
Okay.
You getting my point?
Got it. Yes, got it. So, like, that is sorted for...
At India level, there are like more than 100 gigawatt of order pipeline which is there. And if you also see the data, there were like bunches and bunches of the tenders which are being floated in the month of August because of this.
Okay, got it. So, like, from an industry point of view, like, what do you foresee for your rooftop segments? Like, currently, I think China is, placing some restrictions on cells, but that's for, like, more than 300 WH per kg, right? So, how do we foresee the scenario for, where Solarium is placed in the value chain, supply chain?
So, I don't think there is any sort of difference it will going to get created for any sort of changes. We have experienced some sort of softening of the pricing rather in terms of non-DCR cells or modules itself. So fundamentally, we don't foresee any sort of difference at least for the next 1.5 to 2 years.
Okay. So the next question I have, like recently, I think Solarium, congratulations on the orders for the panels, I think from 4 companies. So can we, since the facility will be operational by mid-January, so can we expect those to add up in our Q4 revenues? Like for B2B, it's much faster than B2G, right? Or will it be a spin-off in Q1 FY27? Correct.
So I'll try and amplify this for everyone's clarity as well. Thanks for asking this, Shruti. So, we have already hired our sales team. So, as you know, right, that the product or the industry solar is more of a relationship industry, right? So we have hired our sales team who is going to sell the modules. And when I say going to sell the modules, which is the additional capacity over and above the captive consumption, right? So we have already hired. Why we hired them a couple of months before? Because it is going to be a cross-sell for them. So we already had a person named Sandeep Vanodia who was part of Granite Global, leading the Germany business. Then we also hired a couple of more people from the industry who are industry veterans, who will be able to sell any sort of additional capacities so as to make sure that the machine or the overall plant we able to scale up at the maximum level capacity utilization as quickly as possible. So that is the intent here. And to answer your specific question, we expect revenue to start flowing in from Q4.
Okay, sir.
Yeah.
Can I continue on like 2 more questions, or shall I join back the queue?
I'm not too sure. Maybe moderator.
Maybe the moderator can.
You may continue, ma'am.
Go ahead, I think.
Okay. Okay. So, from the IP proceeds, we have quite a lot of, the proceeds we haven't used for working capital. So, like, why aren't we using that, like, currently, or what are the plans for using those proceeds?
So more specifically, why we haven't used it, it is more to create a credit history. We have been able to secure decent level of credit lines from our lenders. So that is the major reason we have not used, honestly. And plus, there is no additional cost on the company for using those additional credit lines. So that is why we continue to kind of explore the credit opportunities and expand for our, basically to create a balanced capital allocation for the business.
Okay, so like that working capital, so that will be, kind of being saved up for the manufacturing facility to be functional, or nothing like that?
No. So automatically as we move forward, the money available or money to be required for our manufacturing facility will also get covered.
Okay.
So we need about 80 odd crores of working capital, 80 to 100 odd crores of working capital, specifically for our manufacturing plant, which we have already available on the balance sheet. That is more like creating a buffer and having a right mix of capital in terms of debt to equity.
So then, I'm just still curious, when will we be actually deploying the IP proceeds for working capital? Will it not be in FY26? Will it be like?
No. This will be,
I think
as soon as the plant gets operational, we expect this to get utilized, which is Q4.
Mm-hmm.
As just what I tried to make here, that as soon as there is a huge amount of working capital which is going to get required for our operations of the manufacturing plant, which is if we operate at say 85% of the manufacturing capacity, the maximum amount we needed will be about 100 crores. So in the Q4 we expect anywhere between 60 to 70 odd crores worth of working capital required for the operations, wherein we expect to use this one and so it is more of creating a pool of capital for the future operations instead of going ahead and trying to do everything and then it's not sure if we get the support from the bankers or not. So creating a right pool of the capital when it is required.
Okay, sir, understood. So recently, the short-term provisions increased from 4 CR to 10 CR. So, like, any specific attributes for this?
I don't have that number handy. Rohit, you have something around that? I'm not too sure. Maybe I've missed that, but just a second. Hello?
Yes.
Short-term provisions around, I think, or maybe Shruti, we can answer it separately if you are okay.
Sure. Yes, sir, no worries.
You can.
Yes, no worries.
Yeah.
And so this last one, for the distribution sales segment that we have in our revenue split, that's for, that's what exactly, like the Sarthi program or like what? No.
That's a pure trading sales, which is about 17 odd percent, I think 15 odd percent, which we continue to do in terms of we are importing certain modules from the companies like Trina and then kind of it's more of a negative working capital business for us and making some money out of it.
Okay.
Yeah.
Thank you so much. That's it.
Thank you. The next question is from the line of Shikhar Gupta, an individual investor. Please go ahead.
Hi, congratulations on the great results. My question is regarding the structure manufacturing facility, where you've mentioned that it has an estimated 5% cost advantage. Can you help in estimating, like, what's the final impact on EBITDA of them?
Thanks, Shikhar. Thank you very much. Thanks for the question. I think I answered that in my first response, which is, so it basically gets covered as what portion of the solar plant constitutes a module mounting structure, which is anywhere about 8 to 10%. On that 8 to 10%, we expect a cost advantage of 3 to 5%. So effectively, it will be able to add about 0.3 to 0.5% on the EPC business.
Understood. And similarly, about the solar module manufacturing, that would also be basically intended towards improving the margins. So do you see, like, the margins improving straightforward, or are there any other factors which might?
Yeah. So I think I tried to answer it in first couple of questions as well. So module manufacturing, in terms of how it will impact the margins will be improvised only to an extent we are being able to captively consume those modules. Okay. Obviously, we are confident that we'll be able to captively consume anywhere between 40 to 50% in like very, very initial period, say 6 to 9 months time. But at the same point in time, we want to see our module manufacturing unit as a standalone, right? So at a standalone level, how it performs, what is the ROCE of that standalone unit, what is the payback period of that standalone unit. So that is what I try to capture. But if we want to practically amplify what sort of margins it will be able to improve, so or any module which is captively consumed will be able to add. So given the module constitute almost like 50% of the overall solar plant, and we'll be able to add anywhere between 10 to 12% of the margins at the EBITDA level, right? So we foresee 5 to 7% of the improvement in the gross margins from the module manufacturing if anything gets consumed in-house. So it will be a composition of multiple things. That is why I try to amplify the answer in my earlier responses as well.
Understood. Thanks.
Thank you. The next question is from the line of Maitri Shah from Sapphire Capital. Please go ahead.
Yeah, hello, am I audible?
Go ahead, Maitri.
Yeah, hi. Just a few more questions. Firstly, on the finance cost, then since this has doubled and probably because of the increase in working capital from the defense projects, how do we expect this to normalize over the next 2 quarters going forward?
So as I think thanks for asking this question again. Somebody else as well asked this question. So that was the reason we actually captured this response in the speech as well as in our presentation, that this is one-off, right?
Mm-hmm.
So as we have already started receiving the money due from the defense projects, so this will be a bit on the bloated side on Q3 specifically. Q4 onwards, this will get normalized. But we also are going to experience a significant growth Q4 onwards. So at an overall level, maybe in absolute terms, it will remain at the similar levels, but with quite a higher portion of the business coming in. You getting my point?
Yeah, because I get. Also for the manufacturing, we are taking a bit of debt, so maybe
Correct.
that
Absolutely.
Yeah.
So maybe in absolute terms, it might be similar or some bit of a higher side. But if we say the one-off thing is going to get settled or normalized within this quarter or so.
Also going forward, how do we expect a split from the government coming in? Because we have a bit of a pressure on the receivables from that side. So do we expect to kind of lower this contribution going forward, or do we expect it to stay in the same level of 40%?
Not really, Mithil. So again, I'll repeat what I have said it for the receivable as well, right? So it is not we have experienced this across, or we have experienced this in the past. We have experienced this as one-off situation, more specifically with the different projects. When I say different projects, more specifically with BSF and all that, and more specifically during a specific period. I think we all know that, right? So it is not something which is a normalized situation. We have not experienced anything with the other projects, whether say NTPC or Baba, or so there are multiple other projects which we are doing, right? So we have not experienced that. The answer to your first question is that. And on the second part, I think as you have seen the presentation as well as the speech, we have a very, very robust pipeline in terms of the unexecuted order book, or say L1, or say the order tenders under bidding. So we don't expect the contribution to go down. Either it will remain here or increase. We don't. So all the orders are pretty much intact, and we want to kind of execute them quickly.
Okay, that is great. Could you also expand on
most of those are with the other than defense. So majority of the orders are from NTPC and HPPL and the other entities.
Okay. Also, could you expand on the IT that we are spending on for the B2C application that we're developing? Is this going to be a new source of revenue for us, or is it going to be something that we're going to give to the clients as a additional sort of benefit to them?
IT? Which IT?
The app that we are making for B2C.
No, it is more of a customer experience, sir. It is more of a customer experience. To improvise the customer experience. It is more of that. Yeah. Obviously, all these steps have been taken to improve the customer experience and then in turn improve your retention rates and conversion rates. But yeah, it is more of those things.
Okay. And do we expect ourselves going into the BESS battery storage system going forward with the EPC? Because we're seeing more contracts being given.
So we have already done energy storage contracts and quite difficult ones way down in Leh Ladakh or Northeast or some sort of Air Force stations. So we have done those, and we again continue to bid for those projects. If the question is around EPC, yes, we have the capability, and we will continue to bid for them and continue to go ahead in that direction, given the market is moving into that direction. If the question is around the manufacturing side of BESS, the answer is no at this point in time, because our focus is to get vertically integrated in the direction we are moving at this point in time, and BESS will be a bit of that for us at this point in time. So in terms of manufacturing, we are not.
Yes. So in a current bid pipeline of close to 900 crores, what sort of I could say like value do it pertains to the BESS, if we could say?
Difficult to answer at this point in time, but there are bunch of orders bidded for here with some sort of BESS as well, but I don't have number handy in terms of what percentage of it will be. But at the same point in time, there are latest technologies of the moving, what we call that, the moving module kind of orders. So there are multiple latest technology being there in those tenders. But yeah, I don't have the number handy for this percentage in those.
Yeah, that makes sense. Okay, just the last question on the unexecuted order book. We have of 229 crores and the L1 of 209. What sort of timeline do you expect for the unexecuted order book to be?
So I think the target to execute them is so in terms of unexecuted order book is something, let's say, not later than Q1 next year. Most of it will get executed within this year. In terms of L1, it will all be dependent upon LOA. But say when it means hypothetically, from the time we receive the LOAs, our expectation to execute them is anywhere between 9 to 12 months from the time we receive the LOAs.
And what sort of win ratio do we have on our bidding pipeline?
So the win ratio, so it's a different way to look at it. So if we see in terms of a single order win, and that order is like say 100 crores, right? Can significantly change the ratio. So if we simply take this number instead of say the value of orders and say the number of orders we bid for either for 1 crore or 10 crore or 100 crore, the ratio is anywhere about 25 to 30%. But in terms of value, it is very, very skewed because one single order we bid it say for 1,000 crores and we lose that or we win that, it significantly moves the ratio. So it doesn't make sense to see it at the value level because of the skewness or the movement or the volatility, because we have bid it for orders as low as like 5 crores and we have bid it for the orders as high as like 1,000 crores in the past, right? So we don't want to probably get into the win ratio at the value level because it will not give a right picture, honestly.
Yeah, makes sense. Okay. And lastly, on the scenario, on the realizations on the modules, we see them trending downwards. Do you see that as a issue going forward because the competition?
Sorry, come again for the last part. Sorry.
So the competition is increasing in the module manufacturing, and we see the realizations trending downwards quarter on quarter. Do we see that as an issue with like a new plant coming in?
So thanks for asking this, Matri. I think it is a good question and would want to answer it in more detail, right? So this is not the first time when the solar industry has seen such sort of volatility in terms of the module pricing, right? So if I want to probably answer it in one line, the answer is this is not the first time the module industry is seeing such sort of volatility. But to go more deeper into the details, right, how the things are happening at this point in time, right? So the module capacities, which people are talking about, say 100 gigawatt, 130 gigawatt, XYZ, right? But still, the module supply timelines remain challenging. Still, we have experienced, and not we, industry has experienced the same sort of shortages of the modules. Or the reason is very simple, that a lot of manufacturing facilities were either old or the new technologies are coming up. So with the latest technology of TOPCon, the erstwhile mono will go off, or that 130 gigawatt of the capacity we talk about, or say 100 gigawatt of capacity we talk about, it's a nameplate capacity, as you all know that the utilization is anywhere between 70 to 75%. Automatically that goes down by 20, 30 gigawatt at the start of it. So, and on top of it, the demand side continues to go aggressively and go up aggressively and kind of create a very, very strong foundation to grow next year more than what it has grown last year, right? Not only in absolute terms, but also in percentage terms. If the industry adoption or say the installation has gone up by 25% last year, this year it is going up by almost 40%. So that is on the demand side. So we don't foresee that, okay, is this because of this? We are unnecessarily trying to link it up with multiple kind of things that, okay, because of the additional capacity, the module prices are going down, but the real answer is not that, right? So it is not the first time the industry has seen some sort of volatility. At the same point in time, if you see the margins, it is because on the supply side itself, the raw material prices are going down. It is not something else, right?
Okay. Yeah, that was very informative. Thank you so much for answering all the questions. And all the best.
Yeah, thank you very much. Thank you.
Thank you. The next question is from the line of Shruti Malpani from Earth AIF. Please go ahead.
Hi, sir. I just have a follow-up question. So what kind of agreement do we have with the Chinese suppliers for the, cells? Are there some long-term agreements or just order by order basis something?
So as we are, Shruti, we are just the relationship which we are now using are the old ones which were there in the past time when we were operating our earlier facility, right? So it is not the first time we are going ahead with the manufacturing. We started this company as a manufacturing unit with the erstwhile technology, right? So we are kind of going back to those relationships, and as once our factory goes live, those relationships will automatically get into the long-term agreements. At this point in time when we are talking, obviously, because we don't want to kind of bind ourselves and there are multiple manufacturers supplying those cells. So, but what we foresee is by the end of Q4, we'll have long-term agreements with most of our suppliers with a cost being left because of the volatility we have experienced. So we don't want to probably bind ourselves in terms of cost, but at the same point in time, we don't foresee any sort of challenges in terms of supply.
Okay, sir. Thank you.
Thank you. Ladies and gentlemen, as there are no questions from the participants, I now hand the conference over to the management for closing comments.
Thank you very much, everyone. Go ahead, Ankit.
Thank you, everyone. On behalf of the management of Solarium, we thank you all for joining us on our post-earning calls today. We hope we have been able to address majority of your queries. You may reach out to me or our investor relations partner, EY, for any further queries that you may have, and they will connect with you offline. Moderator, we can now close the call. Thank you all.
Thank you, sir. On behalf of Solarium Green Energy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.